Hello students, in present video I am going to explain about first problem from partnership accounts topic. I am taking this question from Telangana State Telugu Academy Inter Second Year Accountancy Textbook. But this video is useful to all commerce students who want to know about this topic. Let us see the question first. A, B and C are partners sharing profits and losses equally with a share capital of 50,000 rupees, 40,000 rupees, 30,000 rupees respectively. So A invested 50,000, B invested 40,000, C invested 30,000. The profit for the year ended 31st March 2015 amounted to 56,000 rupees before allowing interest on capital at the rate of 8% per annum and salary to A 6,000 rupees and a commission to C 4,000 rupees. Prepare profit and loss appropriation account. This is a question. Let us see the solution for this. Before starting the solution, let us see the introduction of partnership accounts. Every businessman is interested to know about two things: financial position and profitability. As per accounting period concept, financial statements, nothing but final accounts, are prepared once in a year to know about this profitability and financial position. In case of sole proprietorship business, final accounts include three things: trading account, profit and loss account, and balance sheet. In case of partnership business, final accounts include trading account, profit and loss account, profit and loss appropriation account, capital accounts, and balance sheet. To prepare capital accounts, there are two methods: fixed capital method and fluctuating capital method. In present problem, he is asking us to prepare profit and loss appropriation account. Let us see how to prepare this account. This is the format of profit and loss appropriation account. It is divided into two parts: debit side, credit side. Here DR, CR. So debit side we have particulars and amount columns. Credit side also same. Heading is profit and loss appropriation account of A, B and C for the year ended 31st March 2015. Let us know some basic points about profit and loss appropriation account. Trading account, profit and loss account, profit and loss appropriation account. These three are accounts now. Accounts are of three types: personal accounts, real accounts, and nominal accounts. These three accounts come under nominal accounts. So while preparing these accounts, nominal account rule we should follow. Nominal account rule is debit all expenses and losses, credit all incomes and gains, profits. So expenses and losses on debit side of these accounts we have to show. Incomes and gains on credit side we have to show. First, trading account. In trading account debit side we have to show direct expenses. Direct expenditure means the expenditure which is incurred up to manufacturing process. For example, firm purchased goods. So from supplier's place to firm's godown or to firm's factory, to bring these goods, firm spends some transportation known as carriage on purchases. So this is an expenditure and it comes under direct expenditure because it is spent up to manufacturing. Come to P&L account. Debit side we have to show indirect expenditure now. Means what? The expenditure which is incurred by the firm after manufacturing of the goods is known as indirect expenditure. For example, carriage on sale. Firm manufactured a product. So to customer's house, firm is going to deliver this product. Firm is giving free home delivery facility to the customer. So firm is paying this transportation expenditure. And this is spent after manufacturing of the product now. So carriage on sale is an indirect expenditure. In P&L account debit side we have to show. Similarly, credit side of trading account we have to show direct income now. Indirect income in P&L account on credit side. So what is the difference between these two? In main course of business operations, the income which is generated by the firm is known as direct income. Suppose take one sole proprietorship business. So for them, main income is sale now. So sales income is direct income. All other incomes in business are known as indirect incomes. For example, interest received, commission received, dividend received, discount received, etc. So we have to show them on credit side of P&L account. In trading account, our answer may be gross profit or gross loss. If gross profit comes in P&L account, on credit side we should take that, no? If gross loss comes in P&L account, on debit side we have to take, and we should start P&L account. In P&L account, our answer may be net profit or net loss. If net profit comes, we should take that amount in profit and loss appropriation account. Which side? On credit side. If net loss comes in P&L appropriation account, debit side we have to show. Now the doubt is, what is the difference between profit and loss account and profit and loss appropriation account? In profit and loss account debit side, we have to show indirect expenses, no? So expenses which are related to business appear in P&L account debit side. Similarly, incomes on credit side, no? So incomes which are generated in business operations, we have to show on the credit side of P&L account. In P&L appropriation account also, debit side we have to show expenses and credit side incomes. Expenses related to partners appear on debit side of P&L appropriation account. Partners related incomes we have to show on credit side of P&L appropriation account. Take one example. Firm paid salary to accountant. Accountant is one employee. To employee, firm paid salary. So this is indirect expenditure. In P&L account, on debit side we have to show this salary. Assume A, B, C are partners. A is active partner. For his extra efforts, firm is paying salary to him. So salary to A. Here A is not an employee, he is a partner. So think from firm's point of view. Firm is paying salary to one partner. To the firm, this is an expenditure. Means debit side we have to show. In P&L account or in P&L appropriation account. This is partners related expenditure now. So in P&L appropriation account, on debit side we have to show. Appropriation means usage, taking. How partners are taking this net profit, that we are going to show in P&L appropriation account. Means how net profit is distributed among the partners, that we have to show in P&L appropriation account. So why trading account is prepared? To know that gross profit or gross loss. Why P&L account is prepared? To know the net profit or net loss. Why P&L appropriation account is prepared? To know how the net profit is distributed among the partners. So in P&L appropriation account, we are going to show the adjustments of partners. Means partner's salary, partner's commission, interest on drawings, interest on capital, etc. And in P&L appropriation account, the final answer, final profit or loss, we have to transfer to partners' capital accounts. So when partners are maintaining capital accounts under fixed capital method, then this profit is to be transferred to their current accounts. When partners are preparing capital accounts under fluctuating capital method, then this profit is to be transferred to their capital accounts. So P&L appropriation account is merely an extension of profit and loss account. With this information, let us start the solution. So partners related expenses and losses, debit side we have to show. Partners related incomes and gains, credit side we have to show. And your assumption is you are an accountant of the firm. Think from firm's point of view, not from partner's point of view. See the question. A, B and C are partners sharing profits and losses equally with a share capital of 50,000, 40,000 and 30,000 respectively. Capital is not an income, not an expenditure. Therefore, it doesn't come in P&L appropriation account. You know this is nominal account now. Only expenses, losses, incomes and gains we should write. So don't write capitals in P&L appropriation account. Next, The profit for the year ended 31st March 2015 amounted to 56,000 rupees before allowing interest on capital at the rate of 8% per annum and salary to A 6,000 and commission to C 4,000 rupees. So in question he is giving profit 56,000. This is known as net profit. So already they prepared trading account and profit and loss account. So in profit and loss account, they got a profit of 56,000 rupees. So with that 56,000 rupees, we have to start P&L appropriation account. We said we have to show this net profit. In P&L account, net profit comes on debit side now. So that amount credit side we have to bring. Because net profit, as per nominal account rule, profits are to be credited now. Debit all expenses and losses, credit all incomes and gains. So profit shows a credit balance. Therefore, net profit credit side we have to show. By net profit 56,000 rupees. Interest on capital at the rate of 8% per annum. You should know some points about interest on capital. Interest on capital. Partnership business comes into an existence with one agreement now. So that agreement may be oral agreement or written agreement. If agreement is in written form, then the document is known as partnership deed. So in partnership deed, if there is any provision related to interest on capital, then only firm pays interest on capital to the partners. So if partnership deed is silent about interest on capital, then we have to follow the provisions of Partnership Act 1932. And what that act says, no interest will be allowed on capital to the partners. And generally, when partnership deed contains interest on capital provision, suppose A, B, C are partners. Assume their capitals are equal, profit and loss ratio is also equal. A brought 50,000 rupees capital into the business. B brought 50,000, C also brought 50,000 rupees. Capital amounts are equal. And the profits and losses, they are going to share equally. So profit and loss ratio is 1:1:1. In this case, generally no interest will be paid on capital to the partners. Take second example. Profit and loss ratio is equal, but capitals are unequal. A's capital 50,000, B's capital 40,000, C's capital 30,000. Assume profit for 1 year is 60,000 rupees. Then A's share will be 60,000 into profit and loss ratio is 1:1:1 now. 1/3, 1/3, 1/3. So 60,000 into 1/3, 20,000 rupees. For B, same. For C also same, 20,000 rupees. So A invested more, C invested less. But in profit, all are getting equal share. So A is giving extra benefit to the firm in the form of capital when compared with B and C. Similarly, B is giving some extra benefit to the firm in the form of capital when compared with C. So A and B need some compensation. Therefore, interest on capital will be allowed to them. Assume interest on capital is 5%. Then how much amount A gets? A's capital 50,000 into 5%, 2,500. B's interest will be 2,000 and C's interest will be 1,500. So if you observe these amounts, A is getting more amount in the form of interest on capital when compared with B and C, because he is giving extra benefit to the firm in the form of capital. Comparing to C, B is getting extra income in the form of interest on capital because he is bringing extra amount into the firm when compared with the C. So remember this point. When firm allows interest on capital to the partners, when capital amounts are unequal and the profit and loss ratio is equal. Interest on capital, firm is going to pay to partners. So think from firm's point of view. To the firm, this is an expenditure. Expenditure on debit side we have to show now. To interest on capital. A. A invested 50,000 rupees capital. On that, 8% interest will be allowed to him. ₹4,000. B invested 40,000 rupees. On that, 8%. 3,200 rupees. 8 into 4, 32. C invested 30,000 rupees capital. On that, 8% interest. 3 into 8, 24. Add these two zeros. 2,400. Total in outer column. 9,600. See the question? And the salary to A 6,000 rupees. So to A, firm is paying salary. Think from firm's point of view. A is partner. Partners related salary. Partners related expenditure. Debit side we have to show now. To A's salary. Doubt is, this salary 6,000 is paid per month or for 1 year? In question there is no information. So in the absence of any information, our assumption is this 6,000 salary is paid for 1 year. So this is final accounts now. In final accounts, always we have to show the consolidated figures, final amounts. So final amount, 1 year salary total amount is 6,000 rupees now. That amount directly we should show here. Suppose in question he has given that to A, firm has to pay 6,000 rupees salary per month. Then don't write that 6,000 rupees in outer column. In inner column, you have to multiply 6,000 salary with 12 months. 6,000 into 12, 72,000 rupees. 1 year salary amount is 72,000. That 72,000 rupees you should write here. So in question, he is not giving per month now. Therefore, our assumption is 1 year salary amount is 6,000 rupees. Write down that amount in outer column. And commission to C 4,000 rupees. So C has given some benefit to the firm. In return, firm is giving commission to him. To the firm, this is an expenditure. C is partner, partners related expenditure. Debit side we should show. To C's commission, 4,000 rupees. So everything we have taken in P&L appropriation account. Finally, you have to calculate the profit or loss. Credit side total is more. Credit total 56,000 minus debit total 19,600. Then the difference is 36,400 rupees. Finally, this is profit. Because credit side we have written net profit, debit side expenses. So profit is more than the expenditure. Therefore, final amount is also profit. This profit belongs to partners. So to their capital accounts, we have to transfer this amount. So you know, capital accounts are prepared under fluctuative capital method or fixed capital method. In question, there is no proper information. Our assumption is they are preparing capital accounts under fluctuative capital method. That is why this profit we are transferring to their capital accounts. Suppose in question he has given that capital accounts are prepared under fixed capital method. Then we should transfer this profit to partners' current accounts. And we said we have to show this transfer where the total is less. Debit side total is less. So debit side, transfer this amount to all the three partners' capital accounts. To A capital account. Profit amount is 36,400. In which ratio? In question is giving that A, B and C are partners sharing profits and losses equally. Three partners are there. So equally means 1:1:1. 1/3, 1/3, 1/3. 36,400 into 1/3. For other two partners also same. To B capital account. Same calculation. 36,400 into 1/3. For C also same. To C capital account. 36,400 into 1/3. 36,400 divided by 3. 3 ones are 3. bring 6, 3 2s are 6, bring 4, 3 1s are 3, 1, bring this 0, 3 3s are 9, 1, bring this 0, 3 3s are 9, 1. So nothing is there to bring. Then what to do? Put 1 point, add 1 0. Then 3 3s are. Stop here. So it will be continued now, 0.333. Then round up value we should take. After point, if the digit is below 5, suppose 0.1, 0.2, 0.3, 0.4, then simply you should ignore. So we should take 12,133. Suppose after point the digit is 5 or above 5, then we should add 1 digit here. Means round up value will be 12,134. So after point digit is below 5 now, therefore simply we ignore this 12,133. So to A, 12,133. To B, same, 12,133. To C, 12,130. If you write a 3, then the problem is, if you add these 3 amounts, 36,400 doesn't come. 36,399 comes. So what we do? To C, we'll give 1 rupee extra. Then 3 amounts if you add, again 36,400 comes. So finally, two sides put the highest total, 56,000 rupees. Debit side also same. So this is all about first problem. Hope this video is helpful to you. Thank you.